Thank you for joining us today at this American Enterprise Institute event on policy for financing long-term care. I'm Stuart Butler. I'm a senior fellow at the Brookings Institutions, just a couple of doors down from AEI. America is a rapidly aging society. In the next 30 years, the number of Americans over 100 will quadruple until up to 500,000 people. And of course, thanks to breakthroughs in medical care and other factors, we're living longer. But often, many of us are living longer, but physically frail and with some level often of cognitive impairment. That means that more long-term care is going to be needed in the future. And that's going to be expensive, both for individuals and also for society, particularly through costs in the Medicaid program. And this issue of financing is what we're about to discuss today. AEI Senior Fellow Mark Warshawsky has focused on pensions and long-term care for most of his career. He's had stints in government at the Social Security Administration and the Treasury, in the private sector, designing retirement strategies, and in research and writing on retirement issues. Mark will be sharing his analysis of the long-term care financing challenge and his views on how to address it. After Mark has spoken, two experts from different vantage points will share their comments, both on his remarks and their own views. Mark Glickman is CEO and founder of Buddience, a company specializing in long-term care technology, education, marketing, and brokerage. Prior to that, he spent over 15 years as an actuary and chief investment officer in the long-term care industry. He'll be followed by my Brookings colleague, Wendell Primus. Wendell is a veteran of Capitol Hill. For 18 years, he was senior advisor on health and budget issues for Speaker Pelosi. He served as director or chief economist with the Congressional Joint Economic Committee, the House Ways and Means Committee, and other key positions. Much of the health and budget legislation of the last 40 years has Wendell's fingerprints all over it. So I'm delighted that they're all going to be joining us today. During the program itself, you will be able, as an observer, to post questions to the panelists. You can use the submit button, or you can email Georgi, that's Giorgi BOKHUA at AEI.org. So let us begin with Mark Warshawsky.
Thank you very much, Stuart. And I also want to thank my fellow panelists for joining us today. This is a topic which is somewhat analyzed and underappreciated, but it's very important both in terms of people's well-being over their life cycle, particularly as they age, and it's important for the government, for people's personal finances as well as the government's finances. So today it's going to be a pretty rapid run-through, and I'm going to have some slides. And why don't we go to the next slide in the agenda that I have today. So first, I'll go over the individual's long-term care problem and the resources that might be available to him or her from their own resources as well as available through the government. Then I'm going to focus on Medicaid because that is the main payer for long-term care in the United States. It's a very complicated system, and I'll go through some of the rules. Then the alternative, which is to buy private long-term care insurance, and I'll discuss the current market, the market as it is developed, and some design issues where it has succeeded and where it has failed. And then there have been various public insurance initiatives over the year, both at the federal and state level. And I would characterize most of them as failures, and we can discuss very briefly why that occurred. And then I have my proposal in terms of where we need to go going forward. Next slide, please. So there's a lot of data on this slide, but let me just sort of give you the highlights. First, it gives you that clearly that the risk of disability, of long-term care needs goes up with age until at very old ages. It's almost universal. If people survive to the very old ages of 95 and older, women have more needs and more disability than men at any age. Not included in that chart, but in the data is that Black and Hispanic populations have about double the risk. There are no demographic differences, however. And for some time, it seemed as if things were improving, that the risks were receding a bit as people lived longer. And that was through the late 1990s, but more recently, it seems to have stalled. So we don't see much improvement in this problem recently. Another way of looking at the risk is to look at it over a lifetime period, so that 64% of women will have some long-term care needs over their lifetime, beginning at age 65, about half for men. Sometimes the risk can be extended for more than 5 years. But one interesting thing about it, looking beyond the lowest income and poor health groups. So for the vast majority of the population, the lifetime risk does not vary by income or initial health. So pretty much the same risk for everybody when you look at income and health groups. And that's an important point, which we'll come back to. But this is sort of needing help. Many people get help and they don't have to pay for it, obviously mainly from their families and other friends and relatives. But sometimes the needs are severe or there are no relatives. And so about 45% will need to pay for care. The duration is less, the risk there is less severe as well. So that's another important point to note, is that there's a sort of, if the government were to step in, the demand could be very large because it could replace the family's provision of care. Next slide. So it's expensive if you do pay for care, and there are various categories in which care can be provided: home health care, adult daycare, assisted living, or nursing homes. And we traditionally think of long-term care as nursing homes, but it's much broader than that. There's big differences by geographic locations, as you can see on this slide. And I think another point from this slide is that even what is thought to be less expensive, home health care, can be pretty expensive. And particularly if you sort of want to replicate what you get in a nursing home with full-time care, from home health care, it's actually more expensive. But the point here is that the expenses are high. This shows monthly cost of care. Next slide. So that's the individual's problems. Let's sort of look at the resources that are available and sort of looking at it in an aggregate fashion. So total long-term care is very large. It's almost $500 billion all told, which is a significant part of the economy. It's mainly financed by the public sector, and that in turn is mainly through Medicaid. Medicare pays part of it, but in a somewhat limited but elastic way. If you're hospitalized and then need to get rehabilitation, Medicare will pay for up to 100 days. And so that is part of the payment, but it's largely, if there is no rehabilitation and it's sort of truly a long-term issue, then the only way of getting public assistance is either through veterans care or Medicaid, and we'll discuss Medicaid in a little more detail. And the other way is getting it is paying either out of pocket, getting it through private insurance, which would be long-term care insurance, some health insurance, and other sources, which is mainly charity assistance. Next slide. So Medicaid is the primary payer of Medicaid spending. Long-term care represents about a third of Medicaid spending. About 60% is spent on home care, 40% on nursing home care. Looking at an admittedly somewhat dated CBO projection, it projects that long-term care spending will increase from 1% of GDP in 2010 to 3% of GDP in 2050. And that's both because of the aging of the population as well as the increase in cost, even beyond regular inflation. And we see here in terms of some data from CMS, both the increase in costs for Medicaid long-term care spending, as well as the government is actually playing a larger role over time. It's almost 45% currently, which is a worrying trend in terms of the government budget and in terms of incentives. So let's now look at Medicaid in somewhat more detail. It has very porous eligibility. People think of Medicaid as just for poor people. And that's the design. You have to be either very indigent, poverty, or have very little in the way of assets. But when it comes to long-term care, that is not true. There are a lot of states that allow Medicaid eligibility if you're quote unquote medically needy, which is a much higher income standard than poverty. And there are also spousal income allowances that basically also increase the income eligibility. The other aspect of eligibility is that you need to be poor in terms of nominally in terms of having very little in the way of assets. Now, when it comes to the elder population, assets really are what is mostly relevant, because you can certainly have people with very little income but very large assets. And certainly when people retire, their income drops, but they may have substantial assets. And again, nominally, the program is just for people with very little assets, but there are major exceptions when it comes to long-term care. There's a major housing equity exception of up to $1 million. And in California, for many, many years, and certainly true now, there is no limit on housing. Many states exclude retirement accounts. It's very highly variable by state, which I don't understand the policy logic of some states including it and some states excluding it, but that's the reality. There's spousal allowances for assets. Recently, CMS allowed California to waive all asset limits to be eligible for Medicaid. And I, for one, am not a legal expert, but I don't understand how they allowed that, because the law is pretty clear that there does need to be asset limits. But in California, they allowed it to waive all asset limits. And so you certainly can be, in theory, you can be a billionaire with low income, and in California, you could get the government to pay for your long-term care. There are also some sophisticated legal avoidance techniques on the various Medicaid eligibility rules, which are used and do allow people with significant assets and income to be eligible. And although you might say, well, this is technical and it just doesn't apply to many people, when you look at the data, and these are very fine studies, we do see that middle and upper income people are using Medicaid for long-term care without having to spend down. Now, a way of recovering that is that the law requires states to go after decedents' assets if they were eligible for Medicaid and Medicaid was paying for them. But if they have assets. But the reality is that a lot of states really don't do much of a job. Picking on California, in 2020, they only recovered $17 million for the whole state, whereas some states do a better job. And so there's a lot of inequity there as well. Next slide. So what about the private market? It's a flexible product. You can get different benefit levels and different extent of benefits. There's modest uptake of private long-term care insurance. 11% of the older population has coverage through long-term care insurance, but it has not been growing. The sales peaked in 2003. There have been some replacements of combination products, and maybe Mark Glickman will talk more about this. But you look at the economic explanation of why long-term care insurance is not more common, and the very significant result in the economics literature is that Medicaid crowds it out, such that people, even middle class and upper middle class people, even without considering the poorest eligibility, won't buy long-term care insurance because they're in some way covered by Medicaid. Now, there are some counterweights in policy. There's some small federal and state tax benefits given. It's very small. And there's something called partnership, which basically, if certain requirements are met in the nature of the long-term care insurance policy, particularly inflation indexing, the individual who has that policy can set aside assets and not be subject to state recovery. And these policies, research has found, do have some effect in increasing long-term care insurance purchases. Next slide. But, although you would think, aside from the Medicaid crowd out, you would think there would be more coverage. One reason why there isn't more coverage is that there is very strict underwriting, so that 20% or even higher of people above age 65 cannot get any coverage mainly because of health issues. Now, this is surprising because, as we said before, and my research has shown this as well, lifetime risk is uniform among most health groups. So why is that so many people are excluded? Well, the reason why is because the way the policy, traditional policy has been designed is it's a level periodic premium. In other words, you pay monthly, quarterly, annually, and this encourages the risk categorization by life expectancy, so that healthier people, proportionally get lower rates, and therefore, given that that's the market dynamic, the insurance companies have to do the underwriting and exclude people with poorer health initially. This way this is done also encourages lapses, so that people will drop the policy over time, and even though they need it eventually. Now this approach may have been reasonable initially because the insurance companies didn't know how much the policy would actually cost. But now that, and in fact, there have been many premium increases over the years. But now you would think that the experience is well established, that there really should not be this need for this periodic premium approach. And we should use a single premium approach for long-term care insurance. And that would limit the need for underwriting. And basically, according to my research, only about 3% of the over age 65 population will be excluded by underwriting if you had a single premium design. And this will be important as we discuss my policy proposal. Next slide. So, we're seeing, I hope I've made a case here that there is a need for change. And it's not like this has not been tried in the public arena, but each time it's tried, I would say it has failed. There was an attempt, and maybe Wendell could go over it a little bit. This is a long time ago already now, with Medicare, trying to expand Medicare coverage for long-term care in 1988. But that was very quickly repealed in 1989 when people realized it was going to be financed by the elderly population through increased Medicare premiums. That was very unpopular, and it was repealed. The next attempt was part of the ACA, the Obamacare, which was to create a specialized insurance program. It would be a very modest amount of insurance. It would not be totally mandatory. In fact, it was largely voluntary, except they were hoping that employers would sign up. And then once you were signed up through the employer, that most people would get insurance that way. As it turned out, a quick analysis showed that it actually looked at the actual written legislation. The program was not viable. There would be a lot of adverse selection. In other words, the people most at risk would buy the insurance. Others would stay away from it. The reason why it was included in ACA is it was thought to produce a lot of upfront revenue, almost $70 billion for the ACA to pay for the expansion of health insurance. But anyways, it was dropped. In 2011, it was stopped. In 2013, it was repealed. There have been other proposals for national social insurance for long-term care. It's various financed by tax increases. I would say that there's been skepticism about these proposals in terms of that they'll be much more costly than estimated. And the reason why I mentioned the moral hazard, in other words, that there's a lot of latent demand for long-term care that people would prefer to get paid care so that their families didn't have to take care of them. So it's potentially a very expensive program because there'll be basically a creep of expenses and more benefits. So given at a time when we have very large deficits in the federal budget and the Social Security and Medicare are looming insolvencies, these proposals for national social insurance have not gone anywhere. So there have been some state efforts. The most famous one, really, I think the only current one is in Washington State. It's called WA Cares. It's a very modest amount of insurance benefit. It is mandatory, pretty much. But I would say because it is mandatory, it's unfair to the poor because they would get Medicaid anyways, but they have to pay the payroll tax. It also is unfair to those who work in Washington State but then leave, so they never get a benefit. Now, I understand they're trying to fix that, but it's a very complicated, I think, really impractical solution. It's very unpopular, and the reason why I say that is because initially there was an ability to get out of the program by saying you had long-term care insurance, and almost 500,000 people, workers, out of about 3.5 million workers in Washington State said they had long-term care insurance. Now, admittedly, there was a big blip up in purchases, but it was nowhere near the 500,000, according to the data that I've seen. So I would have to candidly say that people lied and claimed they had insurance and they did not, which is not great public policy. Anyways, there is on the Washington ballot this year, there is a ballot issue to make the program totally voluntary. And I think some people say that it will pass. Next slide. So what is my proposal in face of all of these problems and issues and directions and trends and so on? I believe that we really, as a country and a society, people need to be able to rely on themselves and finance for themselves if they can afford it. Now, if they can't afford it, they need assistance. And if they're very poor, they need total assistance. But the current direction that we're going in is that we're relying more and more on current systems, even for people who can very well afford it. And I think, and also given the trends in terms of government spending, we need to change direction. Now, I'm not proposing anything radical, not any brand new programs. I'll rely on a proposal on current institutions and laws, just making a couple of, I would say, relatively small changes, but significant changes that will change the direction. So we need to refocus Medicaid and get it back to what it was intended to be, which was to help the poor and the lower middle class, not the upper middle class and the wealthy. We need to really focus it consistently and with a lot of effort. We need to enhance the partnership idea in long-term care insurance so that basically people will be encouraged to get long-term care insurance. But with that, we also need to revitalize and reform the insurance itself. The idea there is to make sure that it's available to a vast majority of people and not prevent people from getting insurance because they can't pass underwriting. And then as a favorable byproduct of this, because once you get the private insurance becoming popular and widespread, well, then you don't need estate recoveries because under partnership, you're exempt from estate recovery. Estate recovery is not a pleasant policy. People, I think, find it difficult. It's unfortunately is needed because it provides the right incentives, but you need to sort of counterbalance it with more incentives to have private coverage. So let's be a little more specific. Next slide. So in terms of incentives, I think we need to be totally consistent across the country that all retirement assets should be considered as assets that are countable for the eligibility for Medicaid. There's no reason why some states account them and some don't. We need to really be very strict in terms of these legal complex asset transfer mechanisms, and those that are currently allowed, we need to outlaw them. Again, this is very technical and a complicated area, but we need to focus on it. California is 1/7 of the United States economy. It needs to follow the law. We need to bring California into full compliance with federal law, both the old law and current law. That it needs. There are so many exceptions that California has gotten over the years from Medicaid law in terms of no limit on housing, in terms of eligibility, now no limits on assets. There are other, again, technical exceptions for California, and we need to bring it into full compliance. The state recovery needs to be enforced consistently, but with the partnership carve-outs. So that, again, this is sort of a carrot and stick. And the way I would encourage non-cancelable single premium and long-term care insurances, I would double the partnership asset offset. So right now it's a dollar for dollar in terms of dollar of coverage, dollar of assets offset that are excluded from recovery. Let's double that in order to encourage the insurance market to develop towards a single premium policy. And that, again, would solve the underwriting problem. The question is, do we need to pass a law to do this? It may be done, it could be done by CMS through state plan amendments. I don't know, I don't have an answer to that question, but if we could do it right on a regulatory basis, we could do it very quickly. One change, again, I don't know if we need a law change or a regulatory change, is I would remove the indexation requirement on long-term care insurance for partnership. It increases the risk to the insurance companies, and I think we need to give them a little bit of a break here. And finally, we need to conduct a public information campaign about these changes, and I would suggest it be done through Social Security, because Social Security gives information when people claim retirement benefits, and I think this is a good time to educate the population about current law and then including these changes that I propose. All right, thank you very much for your attention, and I turn it back to Stuart.
Thank you very much indeed, Mark, for walking us through a very complex challenge that we face in this area. And I really appreciate you doing that and raising a lot of the issues we have to think through. Let's now move to Mark Glickman, who, as I said, has got a lot of experience in the industry itself in terms of getting your views on this.
Thanks, Stuart, and great job, Mark. I echo a lot of your sentiments, and I'll share some of the things going on in the private marketplace. I'm an actuary by background, so I help design a lot of the traditional products that are in the marketplace. Believe it or not, Mark, there is a single premium partnership qualified traditional long-term care product in the market today in 49 states. So it does exist. The challenge is that it's not as competitive in traditional long-term care because the insurance carriers are concerned about the risk. And there aren't a lot of new products being developed there. We are seeing a lot of development, as you mentioned, in this combination market, which combines life insurance with long-term care features. And because of the competition in that space, the long-term care benefits for the premium dollar has actually rivals and maybe even exceeds the amount of insurance leverage you can get from a traditional product itself. So we're seeing a lot more innovation happening there. Now, I'll put on my broker hat because I'm also an insurance broker licensed in all 50 states. We have a general agency that helps clients implement long-term care for their clients. And we're seeing a lot of growth in that combination marketplace, working day in and day out with clients. Where that's happening primarily today is actually with the group long-term care market. And so when I think about Washington Cares, which you had talked about, we helped about 1,000 employers in Washington offer long-term care to their employees in 2021 when that happened. And you're right, people were buying it primarily just to get out of the tax. It wasn't a planning conversation. It was more of a, how do I get the least expensive product so I don't have to pay the tax? But here's the interesting consequences of that. Up to that point, we had significant supply challenges in the market, a dwindling product lineup of traditional products, combination products, which hadn't really gained a foothold quite yet. And what we saw was that because of the state's, stimulus in terms of promoting the fact that people needed to buy a long-term care product, we saw a large number of group insurance carriers enter the long-term care space. So back in 2021, we may have had one or two products that had a long-term care rider on their life insurance policy. By the end of this year, I'm seeing that we're going to have at least 10 carriers that have entered the market because of the state potential to do a payroll tax, not just in Washington, but now in about 15 other states that are discussing legislation like California, New York, Minnesota, and many others as well. So what's happening is because of the government, I'll call it awareness about long-term care driven through these payroll taxes, it's stimulated the supply of products in the market, and it's become a very competitive marketplace. At Buddy INS, in partnership with large employers and associations, we will educate over 1 million people this year on long-term care insurance and planning. Whereas on the individual traditional market, maybe less than 50,000 people are going to get an individual product. So we are seeing the market shift, but it's because of a supply challenge that's been addressed and a lot of competition in the space. I'm going to go ahead and share my screen. And I can't read all the live stream questions, so if you guys see a question, feel free to shout it out to me. Let me go ahead and show you guys. And this is a software program that we developed for brokers to share with their employer clients and with employees, for example, during enrollments. And this is a product from a large carrier called Chubb that many people have heard of, that's big in the property and casualty space, but offers worksite benefits. And has developed a product through a partnership with another carrier that's a life insurance with a long-term care feature. Now, how these products work is that you purchase a death benefit amount. So in this case, 150,000 death benefit. And the insurance company is going to accelerate 4% of that. So you can use it early. So you're not using it upon dying, you're using it while you're living if you meet the eligibility criteria for long-term care, right? 2 out of 6 ADLs or a severe cognitive impairment. So you can draw down $6,000 a month to pay for your care or to pay for an assisted living facility and all the different care settings that you mentioned, Mark. Now, not only does it give you long-term care over 25 months, but it extends the benefit for another 50 months. So you actually get a total of 450,000 of long-term care over 75 months, or a little over 6 years to cover that, 5-year plus duration risk, right? You mentioned 22% of people need care for a lot longer. But the key thing for us is it worth the premium dollar, right? Are you getting good insurance leverage from the insurance companies? And if you look at a 45-year-old female, and we'll project this out to age 70, we can also kind of project this out a little bit older just to kind of show what it looks like in one of those scenarios at later age. But $200 a month premium over 25 years here would be $60,000 of premium paid into it for a total potential, if you needed all the amount of care in the policy, of $450,000, which means for every dollar of premium, you have $7.5 of insurance protection. So from my perspective, the two key things that this really addresses in the market is it provides a more affordable solution, right? A much lower average premium. You can even buy this down to as little as a $25,000 death benefit. So 1/6 of the cost here, $33 a month premium. And it's become more of a supplemental market, right? So the real big issue with long-term care is their perception of affordability, and even the rate increase risk on the traditional side has led people to feel unconvinced, right, that they're going to have a stable premium over time. These products have more or less guaranteed premiums, guaranteed level premiums built into them. But it's supplemental because a $6,000 monthly benefit, while it's good today, right, towards the median cost of care like you showed in the Genworth survey, what about the future, right? This does not have inflation growth on it. So if you look at 25 years or 35 years into the future, this monthly benefit needs to be a lot higher to cover the full risk. Maybe the cost of care in the future would be $20,000. But the key point here is that if somebody is buying a little bit of coverage, maybe even to cover a few hours of home care, professional home care, is that going to do a great thing for their family, right? To protect against the risk of them quitting their jobs, et cetera, that we've talked about, and becoming family caregivers. And I think the answer is yes. And that's why these, I think, supplemental solutions form a nice balance between what the private market is willing to offer in terms of carriers feeling comfortable with a more capped risk, but what clients can benefit from in terms of good value and getting a starter plan. And then they can always add an individual policy to add on top of this. So the education that we do during these enrollments goes a long way towards people understanding what the value of this is. I'm going to do a comparison now. I'm going to show you what this looks like compared to one of the leading traditional long-term care solutions in the market. Same client, 45-year-old female. I did the same plan design. So this is a 6-year benefit. And you can see, look at the premiums, total premiums, benefits, almost identical, right? This product here, Mark, is guaranteed issue with no health underwriting. Every client that's buying this during the enrollment period from their employer or from an association, we offer this to association members as well, gets this product as a special enrollment with no health underwriting. This product, if you don't use the long-term care benefits, you still get the death benefit as a consolation prize, we'll call it, but you're pretty happy you didn't need long-term care services, right? So you're going to get basically at least a return of your premiums paid into it as long as you keep the policy in force. So there's real competitive reasons why clients are choosing the hybrid products, why they're more competitively priced. The key thing is, are the carriers comfortable with the risk? And I would say in this marketplace, maybe they're going to raise their rates on new business going forward because they're looking at this competitiveness and saying, hey, we have to be more careful about our loss ratios. On the traditional side, I think they're pretty comfortable because it's more conservatively priced. But just keep in mind from a client perspective, a lot of times they're going the hybrid route because it's more competitive. I'll pause here. I don't know if Mark or Stuart or Wendell, if you have any questions or comments about this, but hopefully it gives a picture of where the marketplace is trending and why. Now, there is a marketplace. This is more for the actively at work population. So picture most of the people are under 65 and the average age is around 45 to 50 of those that are buying it. In the individual space, there are marketplaces also for those that are 65 plus. But again, they're turning into supplemental markets. In many states, there's a product called short-term care. And in all states, there are some traditional products that have been designed with 1 or 2 year benefits with simplified issue underwriting. And the reason for that is, even if we cover the first year of care, does that do a great service for families that are buying it, having the first year covered, even if we don't have a 6-year event covered? And I think the answer is yes, but more of a supplement, right? Where we're carving out the first year and we're buying the family time to come up with a more comprehensive plan once they know the diagnosis and the situation. So short-term care is designed to be a 1-year alternative to long-term care, and it's priced very well for those that are 65 and older. And in fact, they go up in age to probably age 85 or so in terms of when you can purchase them. So again, another type of supplemental product that covers a small portion of the risk, has more limited medical underwriting, so more people qualify, and is becoming more popular and more carriers are offering these products because they're comfortable with not having to pay the catastrophic longer term events, and they can more carefully price that first year risk and have a better idea of what the probabilities are in that occurring. There are also some other solutions like annuities that have long-term care riders on them as well. Really attractive for those that are 65 and older because you buy a product with a single premium, Mark, to your point. Let's say it's a $200,000 premium. Now, a client has to really be comfortable about spending that type of money, but you're never going to get less than $200,000 because the annuity always has a growing cash value in it. But if you need long-term care, it gives you up to $600,000 of long-term care payable over 5 years, tax-free. So instead of getting taxed on the gains in the annuity contract, the LTC benefits, when used for qualified services, come out tax-free. So there's a tax incentive in there. There's also insurance leverage. And for someone that's 65 or older, 3 times this insurance multiplier looks like a very good deal, especially relative to a traditional or a life insurance-based solution where the life insurance can get a lot more expensive at ages 65 plus. So again, another, I'll call it type of supplemental product because it's not going to cover the full cost of care, but you're going to reposition assets in a way that's going to leverage the client's money and make it attractive for them to purchase. So I would say the innovation that's happening across the market is that we're not just offering one type of product anymore, traditional long-term care. While this is still a big, important part of the products that we do offer, there are now 7 different types of products we offer for long-term care, whether they're health-based like short-term care or traditional long-term care, life-based like the group or the individual life insurance hybrids, or annuity-based. The insurance companies are getting creative because they need a product that they're comfortable from a risk perspective selling that's also attractive for consumers to buy. And what the real solution is it's going to be a combination of financing mechanism that's going to lead us in the right direction, meaning that you're going to have public programs that play an important role, but you're going to have private policies that supplement and provide the type of quality of care you're looking for and the choice that you want, where the public financing may not be available. It's very difficult, Mark, I'm not sure if you mentioned this in your segment, to even get a home care waiver on Medicaid anymore. There's probably an 18-month waiting list in most states. So if you're not getting care in a nursing home, you don't have as many options to get care to stay at home, which is where most people want to get their policy, to use their policy. We see in the private market, at least 70% of people want to get their policy to pay for a professional home care aide. And another 15 to 20% want to be in a high-end assisted living facility. And that's also where a lot of the more severe cognitive claimants go, because they can have a more controlled environment, right, and protect them. So if 90% of people want to get care outside of the nursing home, and Medicaid is only providing care in a nursing home with very strict requirements for getting home care waivers, the market also is deciding they don't want to end up on the public dole either, because they're not getting the type of care they want. So I think it's really important to understand that we're layering these different financing together. Private market, if you run out of money, we love the partnership program because it kind of is built that way. But maybe at the end of life, when you need nursing home care, then that's when Medicaid kicks in. But it's not covering people for years, right? It's covering people only for the last 6 months. So just some thoughts on the market, and again, happy to go into more depth for those that have questions, or if we see something live streamed today.
All right. Thank you very much, Mark. I know we'll be returning to some of those themes that you raised, and some of the new types of product in the market and what their implications might be. Again, just to remind everybody that you can submit questions, and we will have a discussion among the panel in a few minutes. But also we want to weave in questions from you as well. So let's move to Wendell Primus. You've seen these issues from the vantage point of making law, and just like to get your views on the issues.
Well, thank you very much, Stuart, and I very much appreciate being invited to participate in this panel. I must say I agree with everything that Mark said, except his proposal. I mean, again, all the things that led up to it, I totally agree with. And I also appreciate what Mark said. And I guess the basic difference between Mark and myself is that I think we need a social insurance answer here, much like Social Security, and that this simply will not work in the private sector. I'll say a couple things. I do think that, in this upcoming election, we're not going to tackle the issue of long-term care. I think inflation, the debt situation, Social Security solvency, and many other issues are going to dominate in the short run. But I do think that over the long run, I mean, the next 10 to 15 years, we could see a solution here, mainly because of some of the things that Stuart said at the very beginning. One, this is expensive. Two, we don't have a solution right now at all. And the baby boom, just because of the numbers, are going to put extreme burdens on Florida and Arizona and California, et cetera, so that I think there's going to be a need to tackle this issue just because of the cost and the fact that people haven't bought long-term care insurance, and I don't see any great reversal of that in the short run. And so I and colleagues at Brookings are working on a number of papers here that are trying to propose a social insurance system. We're tackling Social Security solvency, elderly poverty, and a number of issues. So go to the first slide. And I will say here, private long-term care insurance will not work. And unless you have a mandate that everybody has to buy kind of a uniform or at least a minimum long-term care policy, I don't see this working. Another reason I don't see it working is just almost by definition, there has to be a lot of redistribution here. I don't necessarily want to say redistribution is good, but because of the extreme cost, I don't think a low-income person can afford, even if you pay throughout an entire lifetime, some of the cost of long-term care, and you're going to have to tax the higher income individuals to make sure that you have adequate long-term provisions. And we can go more into this in the Q&A, but I just do not see private long-term care insurance solving the issue. I think we need long-term care because many of us, as Mark showed, are going to need it. And we both need quality care at home, as well as, and because mainly people do not want to go into institutions, and there is an ability for much of this to be cared at home, especially if there is a spouse around yet. And I realize that doesn't happen in all situations, but I think quality care at home should be an entitlement. I think there's a lot of care right now that is being provided by relatives, and we can't convert that into paid wages or we will have extreme cost problems. I think participants should be contribute on the basis of their ability to pay. I would argue we need a social insurance scheme added to Medicare so that anybody who is eligible for Social Security or Medicare would be entitled to long-term care services. We need alternatives to both home care and nursing home, maybe adult daycare, maybe more assisted living. Right now, assisted living is primarily for the wealthy elderly. I think we've got to do explorations of housing and other ways of making that available to more of the elderly. And clearly, we're going to need new revenue. The next slide goes into a little bit where we are headed, and we still have a lot of details to work out, so I'm going to stay at the 20,000 foot level here. But I would argue we need a trust fund, much like the hospital insurance trust fund, where you have a dedicated set of taxes, a defined set of benefits, and that the federal government would contract with specially trained nurses to determine eligibility for long-term care and what the benefits are. I mean, there is great variety in terms of activities of daily living. Some people initially could get by with very little assistance. And then over time, like my mother, for example, who had a stroke at age 83, lived for 14 years and had to be taken care of in a nursing home, fed like a baby, etc. There was basically no other way to take care of her. I think the defined set of benefits, the next slide, you need home care, and that home care would be both nursing, home health aides, some medical equipment. You also homemaker services, personal care services, some individuals, adult daycare services, and all of this care has to be coordinated. And you also probably need some transportation services as well. So there would be a clearly defined set of benefits as part of this social insurance scheme. The next slide talks about the financing. And I think a good part of this is going to come from individual contributions, both in terms of assets and income. And when we're talking about assets here, a lot of Americans have own a home. And I think you've got to think about a reverse mortgage. So a good part of this care has to come from the income of individuals as well as assets. And just like Mark suggested, there has to be strict requirements here that people cannot take their assets. And this happens today in the Medicaid world, where people recognize they're going to need long-term care. They get rid of their assets, get it over to their kids, and that way they qualify for Medicaid much quicker than they otherwise would. I think some of this, again, if we have this universal social insurance system, it will relieve the states of a substantial amount of cost. And we can think about a state clawback to get some of the monies that states would have spent and put into this trust fund that I'm talking about. We think a federal income surcharge in the 5 to 7% range, starting at age 50 to 55. And why do I say that? One is, I don't want this mechanism or this tax just to be levied on wages. So this would be, you'd calculate your income tax just like you do now, apply 1.05 or 1.07. And I don't think we should start that tax until age 50 or 55, because, you know, young families are having to buy a home, they're having to take care of college education, et cetera. And a lot of also people don't start thinking about their long-term care needs until later in life. So I think politically, this would go down easier. It obviously makes the surcharge larger if you don't tax people until age 50 or 55. And then that tax would continue for the rest of their lifetime. And obviously, because it's a surcharge, there's many elderly that don't pay any income tax whatsoever. They wouldn't, again, 1.05 times 0 is 0. So they would not be paying anything. And perhaps we also ought to think about some additional, it should not say avenue, it should say revenue, like inheritance taxes, et cetera. So we're still working on the details of all of this. But I think, as the next slide says, well, there's one other thing that I really want to bring to people's attention. It doesn't deal directly with the issue of financing, but in our minds, we are going to have to increase legal immigration. I mean, the question I would pose to the audience is, given the fact that our fertility rates, I mean, the Social Security actuaries predicted to be 1.9 in their latest trustees report. CBO expects the fertility rate to be 1.7, which means we're not really even keeping our population constant. It would decline by about a third with a fertility rate of 1.7. That needs to be about 2.1. So right now, there's many of us that believe unless we import and raise legal immigration limits, there is no way that when the baby boom reaches age 85, 90, that there's going to be enough direct care workers to take care of long-term care needs. I mean, forget the financing of it. There's just not going to be the population needed to take care of it. So I think we've got to, I realize right now, immigration is talking about the issues at the border, but for both Social Security solvency issues, for deficit reduction issues, I think we need to raise legal immigration limits significantly. And under the actuary's assumption, if we increased our immigration levels significantly, it could solve about a sixth of the Social Security solvency problem. And then my final slide, I think we're still working out the details of all of this, but there's no doubt that in my mind, and I think many of my colleagues' minds, et cetera, this is crying out for a social insurance system where people are taxed on their ability to pay, and everybody is given a uniform long-term care benefit that meets their needs. And I'll stop there, and I'll be glad to take questions. But I just, again, I want to emphasize what Mark Warshawsky said in terms of the problem, et cetera. I could not agree with him more in terms of the situation we're facing today. Thank you.
Thank you indeed, Wendell. And let's begin the conversation by maybe Mark Warshawsky, I'd like you to maybe comment on what you've heard from your commentators. You had Mark Glickman essentially, I think, essentially saying that there's a lot of innovation in the private market, and you, in a sense, understated that. And maybe there's a lot more solutions in that area and combinations and so on. And then Wendell says, well, that's all good, well and good, but you're still not going to solve the long-term problem until you really create more of a national program to ensure that people just do not fall through the cracks or do not end up being a burden on states, as so many of them currently are. So I just wonder how you react to their comments.
Yeah, thank you. And I really enjoyed their comments, provided a lot of grist for the conversation. You know, with regard to Mark Littman's sharing with us, some of it is actually new to me. I did not know there was a single premium partnership policy in 49 states. I got to learn more about that. But I really, at a much broader level, it was very encouraging to hear about the innovation and that there could be competition in the market, because basically the reason why, you know, people perceive that the insurance is expensive is because there aren't many carriers, and therefore it's expensive insurance. But if you can, you know, get competition, obviously that brings costs down. And so, you know, it's very encouraging to hear that that occurs in reality, and therefore I think there is a substantial reasonable expectation that, according to my proposal, that if we provide the right incentives for insurance companies to enter this market, because they would create the incentives would create demand, the supply would be there. So I was very encouraged by his overall comments to sort of be encouraging to my proposal. You know, obviously, Wendell and I have a pretty fundamental disagreement in terms of the roles of private and public sectors here, but I think a couple of points. You know, the history of Medicare in this area was not good. This may be before Wendell's time. You know, the Medicare expansion in 1989, excuse me, did not go well, and it was paid for primarily by the elderly, maybe not people age 50 and above, but people age 65, and they revolted. And that was before, you know, the imminency of the Social Security and Medicare insolvencies. So I'm much more skeptical, both as a political matter and as a budget matter, that what Wendell is proposing is doable, given the budget situation and the prospects of the budget situation. You know, defense will have to be increased, et cetera, et cetera. I don't know that we have the capacity, given that we have to solve Social Security and Medicare and healthcare more broadly, the expenses of healthcare. So I'm much more even aside from a political philosophy disagreement, as a budget matter, I'm doubtful.
Thank you. There's an interesting question about patterns of health as people age and what implications that has to this discussion. The question says that in some instances, of course, people with ill health do not live very long. On the other hand, we are seeing incidences of forms of chronic illness or chronic conditions where people do live a very long time, Alzheimer's being an obvious one, other forms of dementia, and so on. So I wonder if you would just, all of you really, comment on, are we seeing changes in the nature of aging and people's physical, mental health condition that has significant implications for this discussion?
I'll just briefly comment on it based on my own research. I really would be interested in Mark Glickman's perspective, particularly as an actuary on this point. The research that we conducted showed that on net, now obviously there are people who live long lives with severe disabilities, but there are also many people who live very short lives with severe disabilities, and therefore, you know, when you combine all the populations together, and if you can group them together in a single premium approach, it does show that you could write insurance. You know, a company could write insurance responsibly with a single premium, and it would cover all those populations and provide a fair benefit. You know, I posed as part of this as a combination of another type of combination of long-term care and an immediate life annuity. And that is very much in the spirit of this observation about combining these populations.
Yeah, I'll put on my actuary hat now,
Right.
and say that it's been theorized for a long time that earlier claims might lead to a reduction in cost because of shorter life expectancy, but that's been pretty thoroughly disproved through the experience in the insurance industry. The younger you are when you go on claim, the higher the cost and the longer the claims are across, the entire board. So there may be anecdotes, right, about shorter types of duration claims, like a cancer type of need for long-term care, but the Alzheimer's need, for example, greatly outweighs that and has a much longer duration of claim associated with it. And as an insurance company, anything you can do to push back the claims allows you to collect more premiums, invest the premiums longer, and ultimately, create higher reserves to pay for those future claims. So it's always better to have people claim later in life because it also creates a shorter claim duration.
Mark Glickman, there's been a lot of conversation about just the long-term viability of long-term care insurance as an industry, particularly if people do live into their hundreds, but in a very frail condition. Are you confident that the long-term care insurance industry itself has both the capacity and really the ability to take on that kind of risk? Or do you feel, you talked in your comments about some of the combinations of partnerships and so on. Do you think the future is some limitation, some ceiling on the potential liability of the insurance industry, with maybe some version of what Wendell is talking about, saying, well, if you go beyond this, if you're one of the outliers, then the insurance company knows that its risk is limited. What do you think of that in terms of
Yes.
the future?
Yeah, that's what I would argue is the best approach to the problem. Like I mentioned, the long-term care insurance is great at becoming a supplemental market,
Right.
not covering the full cost, but having the public policy and the public programs provide more of the catastrophic backstop. I think that's a much stronger solution. The insurance companies are willing to offer products in a supplemental fashion because they can show what the limited amount of risk is, the total amount at risk for them. And therefore they'll offer more products and create a more competitive marketplace. So there's a number of reasons where those two work well together. As a policy perspective, right now partnership only covers traditional long-term care, but it could be expanded to cover combination products, for example, which could stimulate carriers to bring more products to market, as well as stimulate clients to buy those products. So I think that those really become a win-win situation where you're taking people off of what would have become Medicaid claims, and you're putting them into plans that they are actually going to get a higher level and quality of service from on the private side. And I think based on what we're seeing from consumers day in and day out, that's attractive as long as we can keep the premium affordable. I think that's where Mark Warshawsky, that's where that single premium model is difficult, is I think it does appeal to folks that have assets where they could reposition an asset to pay a single premium. But most people, just like when they buy a house, they want to have a 30-year mortgage and spread the costs. Most people want to spread the premium cost of the long-term care. And the more carriers that offer recurring premium solutions, the more we see the popularity of those solutions grow, because they just don't want to put out a huge outlay. That's the limiting factor there.
Yeah, and I appreciate that, and that's why I basically double the incentive to have a double exemption from the estate recovery is precisely to provide that incentive. Of course, when we're talking about retirees, people do have assets. They have their retirement assets, they have their house, and other assets, and so for many people, again, it's not for the poor, but for many people that are currently on Medicaid, who are upper middle class, I think they certainly can and should, avail themselves of of insurance coverage, and they need to be encouraged to do so, both by a carrot and stick. And the carrot is the double incentive, and the stick is to enforce the Medicaid rules in terms of a stricter eligibility requirement. I certainly would allow for these allowable partnership policies that they not necessarily be catastrophic. So it would be totally reasonable to have, 1 or 2 year initial coverage. And then particularly, for truly middle-class people. And then if they need the extended care, then they would become eligible for Medicaid. And that's a totally reasonable outcome. And it would, again, compared to the current situation or the current direction, it would save the government money. It would bring in private assets, but at the same time would not burden people beyond what they could afford. So I think that certainly could be a solution. With regard to the issue, I'd be interested to have a further discussion about who the relative risks. And there certainly is a segment of the population that lives a long time and is in initial long needs disability care for many years. But again, my research, based on the data that we put together, which are bona fide databases in terms of disability and longevity, show that it does work out, that you could have a single premium policy that would be both fair and that would not result in these catastrophic outcomes.
Yeah.
But
and Stuart,
but picking up
go ahead, Wendell.
on,
Sorry.
Let's just take Mark.
on what both Mark both Mark and Mark have said, I think we ought to develop a better financing system for the Medicaid long-term care solution here. I mean, it's a little unfair to expect the Arizonas and the Floridas to have to pick up the cost because more of the elderly live in those states. So my point is we ought to have a financing mechanism for at least the catastrophic portion of long-term care that both of you are referring to. And one thing that private insurance can't do is say your benefit relates to your income very well. I mean, in other words, you reach a certain need for for activities of daily living, you're limited, and then the insurance mechanism has to provide you a uniform benefit. It can't look at your resources at that point in time and say it needs more or less. So again, I'm willing to think about a system where we have a public and a private, but I do think, as you both hinted at, the private part of this has kind of got to be a uniform limited benefit, whereas the public part then has to supply the catastrophic portion of long-term care.
But it does sound, Wendell, that you would be open, or at least you're thinking along the lines of your earlier proposal as perhaps being a sort of an add-on or a catastrophic or a last, whatever term you want to use, with some.
But I still think even there you need more public regulation of the private insurance. I mean, you're going to need something that was the most difficult part of the Affordable Care Act, an individual mandate. In other words, if you want everybody to have this supplemental coverage, so to speak, you're going to have a requirement that everybody buys it and have some minimum conditions for it, it seems to me.
Yep. Well, actually, and that's kind of where one thing I wanted to mention, Stuart, as well, is I think it's important that the public policy look at what the individual market is doing to figure out how to build a complement or a catastrophic backstop, because where we're seeing the insurance companies are uncomfortable with the risk is on lifetime benefits, unlimited duration claims, on inflation growth, especially a higher amount of inflation growth. So if you know that the private market can provide 1 or 2 years or can provide 6 years for more of a limited monthly benefit amount, that allows you to decide what the public program is more effectively. And I think if you incentivize the purchase of private insurance by providing the public solution, you don't necessarily need the mandate that Wendell's discussing, which again, there's a lot of debate around the cost of that and whether there's political ability to do another high income tax effectively to fund that. The payroll tax showed us, right? Just that Washington State experience showed us that with the right incentive structure, people will buy private insurance. And again, Mark, I know you talked about it wasn't as many people as as people think, but I can tell you from the industry statistics that it increased the amount of private policy substantially. So just to give you an idea, in 2021, when they implemented the Washington Cares Fund, the entire private insurance market doubled in one state, but it doubled the whole national sales for the prior year in one state. So there was some amount of individual purchasing going on, because I can tell from the industry statistics, even if a lot of people lied on their application and applied for an exemption without buying anything, right? So it did have a stimulating effect there.
No doubt about it. I mean, I've seen some of those statistics, and I think I saw that it was about 150,000 individual policies that were sold in Washington State, and that would be consistent with what you're saying. But it was 500,000 who claimed they had.
Well, I think the one thing that wasn't being counted in your survey there is the number of group policies. There were another 250,000 group policies sold. That's where we're getting to that 500,000 number. Why it's a lot closer.
There's some good questions coming in, and let me just take one quickly for you, Wendell, which really gets us a little bit into the whole issue of labor participation. But the question is, do you think an income surcharge, as you've suggested, for people, I think you said over 55 or 50 to 55, how will that affect their labor participation? Are we going to see people dropping out of the workforce as a result of that? And what kind of impacts could that have?
Well, that's a good question. I think the surcharge we're talking about here is small enough that it will not affect labor supply greatly, and you pay it regardless of whether you're in the labor force or not. Obviously, the amount would be different if you're still earning wages, but I think I do not think that would affect labor supply significantly.
Mm-hmm. Mark Warshawsky, you talked at the beginning of your comments about the fact that a larger proportion of women tend to be they live longer, they tend to need more care. There are also, of course, a larger proportion of caregivers in family caregivers, and many drop out of the workforce to do that, or at least reduce their work over the years. And what economic impact do you think that is having? And do you think that the kinds of solutions being offered would materially affect that?
Well, I mean, it certainly is the current case that that women do have greater needs and are also more likely to provide the care. So this is a very important issue for women, which I think in the current situation, in the current system. So therefore, I think that they should be more open, hopefully, to some of these types of solutions that such that I proposed, where you will call on the assets of the couple in advance. So it's not just that the husband gets the paid care and then there's no money left for the for the wife. I think if the insurance policy would be for the couple, and therefore provide the coverage.
Yeah, Wendell, do you have any thoughts on that too, in terms of, as you said, the numbers don't work unless we see a much higher rate of immigration? Do the numbers also have to have more women going back into the workforce who at the moment are providing care for a relative?
I mean, I think more women entering back into the labor force would help a lot, but I just don't think the magnitude of the number of workers we're going to need in the long-term care industry, and given our current fertility rates, it just doesn't work. I mean, obviously with fertility, you don't have a worker until 18 or 19 years later. But I just don't think we really do need, and I think more people are recognizing it's not just in our healthcare industry. I mean, the American Hospital Association says we need 200,000 nurses. And, I talked to the direct, nursing homes and the long-term care industry today. They all recognize that raising legal immigration has got to be part of the solution here to the workforce problem. And then because it solves partly the workforce problem, bringing more workers into this country then helps. They will pay revenue, they will pay payroll taxes and income taxes, and that will also help both our deficit situation as well as our Social Security solvency issue.
One of the questions is bringing up politics in all of this. I can't believe this, but the question is, in the current political climate, what do you think are the prospects, maybe in the short term and the long term, of really addressing these issues? I can let anybody jump in on that.
Well, I think Wendell addressed it in part that there's no prospect of doing it in the short run. It's not going to be an issue doesn't look like it's going to be an issue in the current presidential election. And there's so many problems. Really an interesting point is, let's say, we do, in the next 5 years, let's say, we have to solve the Social Security problem. We have to solve the Medicare solvency problem. The question then would be, can this be rolled into that? And really, I'm curious as to what Wendell would have to say about that. If it would, in a way, it's appropriate that it would be rolled into it. But I given the revenue demands just of the current programs, I just don't know, and the complexity of this issue. I don't know that there's capacity to deal with it at the same time. But as a policy matter, it would be good to do it at that point.
Yeah, I think it's going to take a lot of public education. And I obviously think, the AARP and other elderly organizations will step up to the plate once we get beyond some of our current short-term big problems in terms of deficit reduction and the like. But I do think just because there are going to be so many elderly needing long-term care, that problem is going to get more public press attention, etc. So, and I was heavily involved in the drug pricing negotiation. A lot of my friends didn't think we were going to get that across the finish line. Mm-hmm. And, we now have given the Secretary of HHS the ability to negotiate drug prices. Most people 2 or 3 years ago would never have thought that could happen. So I'm an optimist. I think this problem is going to be so great that it will get attention, and because it has to.
Yeah, and I think a cost reduction solution has a lot of merit on both sides of the aisle. So if you quantify, and I think, Mark, you might have done this in your slides, the cost of the unpaid caregivers hours, I think it's something on the order of over $500 billion a year. So if we're able to provide resources to help the family caregivers, and we're seeing some things with like the CMS Guide program and different incentives there, some technology partners. We have a partner called T-Care that is a technology company, provides help for family caregivers. That reduces the cost burden by providing access to the local resources. I think those incentives for those types of solutions are a part of the answer.
Yeah, so I actually will second you on that in terms of the importance of introducing more technology in this area. So obviously, as an economist, there's production is a result of the application of both labor, which might include immigrant labor, as well as capital. Right now in long-term care, home care or nursing home care, it's largely labor. And so I think we really do need to look to technology, to capital, to help provide the care, and that would reduce costs. And I think that's another issue which we're not equipped to in this session to talk about, but I definitely think it needs to be introduced into the equation, and really to provide the incentives for the introduction of capital and technology to provide care I'm not smart enough to know whether artificial intelligence is that technology, or robots, or what have you. I think providing the financing through the private sector tends to encourage those type of solutions to come forward more than the government financing.
Yeah, Mark
I'm-
Glickman. Oh, sorry, go ahead, Wendell.
I'm going to agree with Mark W. Again, I don't know exactly all the details about technology here, but I do worry about Mark Glickman's issue, because right now that care is being provided for free. And if we start paying for it, it will add to the cost. Yes, it will help those families. I get that, or help the people we're paying. But I think you've got to worry about paying for family members giving care, because that will just add to the cost.
Well,
it doesn't necessarily subtract.
Well, I'll give you an example where it does. So there was a study that they did with using the T-Care service to provide family members caregiving support. And they were able to show that they delayed claims onto Medicaid by on average almost 2 years. So by providing help for the family caregiver, it's a lower cost of care overall.
I mean, that's an interesting result, and I think it would have to be very carefully designed. But in general, I'm agreeing with Wendell, and that was one of my points on one of my slides. Is I didn't quantify the $500 billion. That $500 billion was what we're actually paying right now for
Okay, so there's another $500 billion that's unquantified, unpaid caregiving.
Yeah. So, but my point in showing on the statistics the difference between paid care and the total risk, there's a lot of risk that is currently being provided that we're not paying for. And if whether it's insurance, private insurance or public insurance, if it would be there, there's a big moral hazard in terms of people would stop providing the unpaid care. So that is certainly a concern of the flood of the cost going to the insurer.
So, Mark G., can I just ask you
Mhm.
kind of 2 quick questions? One is, how do the people in the industry that you deal with, how do they feel? Or what do they think of as the political prospects of changes? And then secondly, tell us maybe a little bit more about what you see as the potential role of technology in this area, both in terms of quality of services and reductions in costs in areas like monitoring people at home and so on, so virtual reality and so on. We see this with people with mental illness and so on. What do you see from the industry point of view as the future, both politically and substantively?
Yeah, and I'll start with the first question. So, where does the role of government? And I think the federal solutions have not really provided much relief and have not necessarily incentivized the private market as much. So that's where the states are now coming up with these payroll taxes. And I think most of the private industry expects that the states that have a Democratic legislature, governor, are going to pass their own laws to cover at least their half of Medicaid or to help solve the underfunding problem in their state. And that's what's driving them to take action with new products, is they can see that it's very likely that that path is going to occur. And it takes 2 or 3 years to develop and to launch a new product. So they need to actually build it now to anticipate when California or New York is going to have a payroll tax, even if it's 2 or 3 years from now. So because it's at the state level, it's a little bit more predictable from their perspective. And they have a real precedent with Washington State. It might change with the election, this fall and the proposal there. But again, the fact that it's happening is leading to real outcomes in terms of more products. So they're reacting to the reality of that. In terms of technology, that there's a lot of promising things. And I think about long-term care, it's not just about the financing, but it's about the whole life cycle of the needs, right? So somebody needs to be educated to even understand there's an issue to plan for. And then they take care of their parents and they need help with that. And then they have to go, have a longer, healthier life. And maybe they need a wellness solution. And then maybe they go and claim and they need help filing their claim and finding the right providers. So it's not just one problem to solve there. There's a number of problems, and a couple of technologies that help you throughout that process is, how do you have the other part of the supply chain, which is the advisor, the broker, be able to stay in touch with their client throughout this entire life cycle of their needs and provide services and solutions beyond just the purchase of an insurance product. And I think one of the things the carriers are doing is that they're starting to build in these extra benefits into their policy. Because even if, like, we looked at that cost benefit, that leverage of the insurance product, even if that's a lower number, the extra services built into the policy provide a lot more value or perceived value to the client to buy the policy anyway. Because they know they're going to get a concierge, they're going to have an advisor, they're going to have other solutions delivered to them that are not just the financing or insurance related. So we're seeing a lot of these ancillary benefits and services entering. There's one service, just to give you an idea, it's called LEQ, which is a robot. So Mark had asked about AI and robots. It's a robot built on AI. It's like a little thing you put in your desktop, basically. And it's like a emotional caregiver for your loved one. So it tells them jokes, it learns their personality, and it becomes somebody that's in the home so that the family doesn't have to be in the home and they can get respite because there is almost like a emotional caregiver there. So not the physical care, but the other, very time-consuming aspects of that process. And that's just one of many examples of some innovation we're seeing all around to solve parts of that long-term care cycle. And there's many different things that you can do there to create value. So I think the more we see those technologies being built into the insurance solution, the more people purchase it to get both, those value propositions.
I certainly think we'd all agree that it's important to think about the future of long-term care and the services as being probably different from what we currently experience and think about. And the role of technology being a very clear one. We certainly know that loneliness and depression related to that is the kind of condition where the sort of devices you mentioned can have an impact.
Right. Or taking your medication, or falling into your hip, and there's all kinds of different aspects to adding value.
And we're also seeing, experimentation with different forms of care, types of care. Obviously, home-based care has grown a lot, but organizations like here in the Washington, D.C. area, we have a large number of so-called senior villages of volunteer organizations that really interact and work with both family caregivers and professionals. I think there's a lot of interest in nursing homes being not just places people go to, but also institutions in communities that could, in principle, provide all kinds of services in the community. And there's a lot of limitations on that right now in terms of the law, regulations, payments, and so on, because that's based on an older image of what the role of these institutions are.
Yeah, the nice thing about the insurance funding model is because it's spreading the risk and not everyone is going to utilize all of the services, they're a much lower cost per person. So you can build in, like transportation services, Wendell was saying, into an insurance policy and only cost you, like a quarter per policy, that type of thing, because again, not everyone's using it, but they're pre-funding it.
There's a quick question for you, actually, and I see we just have a few minutes left. Specifically for you, Mark Glickman. It says, you mentioned the level of premiums, the fact that previous long-term care plans sometimes raise premiums quite sharply and discourage people either buying or keeping their plans. Is there any change in as somebody that has long-term care insurance and gets letters saying we're going to raise your premiums? What do you see the pattern in the future in that area?
Well, the reality is that the original products were so underpriced that no matter what the rate increase is, typically it makes the most sense to hold onto your policy and pay the increase. Because if you only paid, $50 a month and they're raising your policy 1,000% to $500 a month, and you go to buy a new policy and it turns out that's $1,000 a month, twice as much as what it would be, it still makes sense. So it's really that spread cost over time, and it's just creating like a pool that can fund that. I think for traditional policies, that's going to come down. So we've seen the worst of the rate increases. You're still going to see them, but they're going to be like milder and milder and milder as they get, more on track to be sustainable. What you're going to see on the hybrid market is a pre-built policy that has guaranteed premiums built into it where there can't be a rate increase. And that's, of course, very comforting to a lot of people that want a fixed outlay and want guarantees. So we're seeing more people willing to pay more for those guarantees
Yeah.
and therefore get less leverage for their insurance policy. But again, towards a supplemental solution, it makes sense.
Okay. And there's a quick question also for you, Mark W. And that's on the partnership program that you mentioned in your remarks. Maybe you can just remind people exactly what that is. But the question basically says, or suggests that many people who have those don't really know they're in partnership programs. They don't really want to end up in Medicaid, and maybe it doesn't motivate sales of long-term care insurance. How would you respond to that?
Yeah, so just to remind people, and I was very brief in my presentation, the partnership is an insurance policy. It's a traditional policy such that if the policy meets certain conditions set by the federal rules and state rules, and particularly that they're indexed for inflation and other provisions, that those policies qualify for partnership. Then, if the person purchases a partnership policy, then the assets that correspond with the benefits that they have in the policy are exempt from the estate recovery. So I disagree with the point of the questioner, because the research does show that it does encourage purchases of insurance. That's a study by Grabowski. Right. I mean, it's a modest improvement, but it is a substantial improvement.
Right.
Yeah, you said it was like 18% or something like that, right?
That's right. Exactly.
Interesting. Yeah. Good. Well, I see we're at time, and I want to thank you all for taking part in this, including the audience and the questions that we came in. It's a complex issue, a very pressing issue, and it's been a very good conversation. I appreciate Mark Warshawsky for laying out the issues and talking about the solutions, and for Wendell to give his perspective from what's doable and not doable politically, and for Mark to tell us a lot more about what's going on in the industry and how we can think about the future. So I want to thank you all. I'm sure there'll be other AEI conversations on this topic, and I know certainly at Brookings we'll be having conversations on this as well. So thank you all, and appreciate the whole session.
Thank you, Stuart.
Yeah, thank you.